Hi, folks. This is Sean Hyman from The Logical Investor. And I want to first mention that I'm finishing up the last little bit of my latest options report. So any of you that would like that, you can get it for any donation of $100 to my PayPal account at paypal.com. And that's you can just send it to the email shmcc2000@hotmail.com. That's shmcc2000@hotmail.com. Again, no obligation to get that. That's only if that's something that interests you. You owe me nothing. Your Logical Investor subscription is enough. It's just simply if this is something that you want more education on. Obviously, it's something I've done lately to help fill some income gaps while also be a blessing to you and fill some education gaps and options and things like that as well. So it's a way to help one another. But again, feel no obligation. It's totally up to you. But I believe that you will learn a lot from it. In this one, in the first one, I talk about how to get an option to operate more like a stock and how to derive some income off something that you want to sell and get out of. In other words, make income on your way out. And then in the second one, I talk about earning income with options and some of your highest probability types of strategies that you can use for that and why. And so that was a really popular one. And then this one, I'm talking about a couple of different concepts. I'm talking about how to structure your trades so that you can have a better chance of success than the way people typically structure their trades. And so it's just a tweak in the thinking and a little bit of adjustment in the habits can make quite a bit of difference. And then the other thing I talk about is, a lot of people just want to buy a call or buy a put and have a very directional bet. Either I want it to go up or I want it to go down. But the problem with that, it's one of the lowest probability outcomes that you can have because your option has to go right in your direction and it has to do it well within the time frame with which you have, accounted for it to do until expiry. And so you have to, that outcome has to happen in order for you to profit. And one of the biggest components of that works against you is the time decay when you're buying a call or buying a put. And in this option report, I show you how to mitigate a lot of that time decay against you while yet still having a buying call or buying put bias out there. So I really think you'll enjoy it. Probably will be like some of these other reports, I believe some thinking and some logic and some things that you probably never heard before or never heard it put that way. And also, I just believe it's conveyed in a simpler way than probably any options book or whatever you would pick up. So anyway, enough about that. But I really want to talk about that for just a second. So this stock we're looking at here is Boeing. We don't own it, and thank God we don't own it. But somebody asked me about it. I went back and looked, and it was back in around in here. They asked me what I thought about Boeing, and I said Boeing's in a bubble. It doesn't mean the bubble has to end tomorrow, but it means it'll pop, and when it pops, it'll end very badly. And how do we know it's in a bubble? Because there's this parabolic move where the price just runs away from the 200-week moving average. Notice how it stays, normally somewhere there around it, to the downside or upside or whatever, but it only gets so far away from it in a healthy market. And then there's this frothy blow-off phase that's a parabolic move, that's a bubble. And when that happens, your potential downside risks are much greater than your upside reward. And it's one of the most dangerous things that you can do. So you're buying overly loved stocks, and I teach you to buy overly hated stocks. So the sentiment's overly positive, and you want to buy overly negative because that's where value is truly created. There's no value to be had in something that's going to the moon. And doesn't mean it can't go up some more. And I told him that, and then for a little bit it did, and then but within a few trading sessions it's lost 16% of its value, and that's just to get back towards the 50-day moving average. Now it might bounce off that or whatever, it could go on up or whatever from there. So it doesn't have to be fully popping right now. but eventually, whether it pops up or goes straight down or whatever, it's going to do, this number. If history is our guide, it'll do some massive ABC popping that will be very bad and bring it back probably more in line to these 120s, 140s, 150s, somewhere in there. And so can you imagine going from 446 to, let's just say, 150? How much risk that is versus, okay, so, you could go from 370s to 446. That sounds good when you think, well, there's this much upside, but look at how that compares to how much downside. So that's why I don't have us in momentum moves, because one, you're overpaying for a stock. Everybody loves it. There's no value in it, and your upside reward is likely small relative to your downside risk. So your risk to reward is so flipped, it's not even funny. And then everybody heads for the exits all at once when you have 117 million shares net sold in just over a few days, all within the same week. So everybody files into the building one by one, and then they try to exit the building when it catches on fire all at once. And what happens when that happens in reality? Everybody can't get out and somebody gets burned, right? That's what would happen if a building caught on fire that was packed out. Well, that's what happens to momentum trades as they get packed out, because the more this goes, the more it sucks people into it, because it seems like free money, guaranteed money, can do no wrong, will always go up. People just get uber bullish about it. People talk about it around the water cooler, how much they're making, how much more they're making on their Boeing stock or their Microsoft stock or their Amazon stock or Netflix stock, whatever it was, anything that's done a bubble like this. Then they're even making in their day job, and there's all kinds of crazy talk that's overly bullish sentiment, and that comes home to roost. These things end up doing these upside down V moves over long periods of time. So doesn't mean it has to happen tomorrow, but eventually they do this. They have a massive well, I screwed that up like that. So they have a massive V move in them, and you don't want to be a part of that. And a lot of people will go, well, yeah, but I'll enjoy this while it goes, but I'll know when to get out. And I have been through so many bubbles in my time of watching markets over 25 years, and I've never gotten caught by one. And it's because I teach you the concepts and the ways that I do. Yet friends and associates and fellow brokers, when I was in the brokerage industry and things like that, they would get sucked into these things, even the professionals, and even they wouldn't know when to get out, because a momentum move like this is an irrational move to begin with. Sure, they can get some more contracts, or they can increase some orders that are above the norm and stuff like that, but here's how that normally works. You get a truth, which is that things pick up or things are getting better, and so instead of it going along like this, maybe it should be going along like this with the pickup in business. But the problem is, here's what ends up happening. See the difference in those angles? So at some point, the truth really gets taken too far and becomes a lie that people believe. And I was discussing this with one of my buddies the other day over dinner, that stocks outrun the story, the increased business, the quicker growth rate, all the whatever the business is they've got on the books and in the pipeline. And there's something about stock investors that will overshoot to the upside, just like they'll overshoot bad news to the downside. And there becomes this big disparity between what something should be at and what it is at. And what you're going to find is that when it crashes back down, it doesn't just come back down to the area where it should be in line with maybe its growth rate or whatever. It overshoots that, once again too, because just like this was an emotional move and an overshoot up, this is an emotional move and an overshoot down. And so it's just a dangerous thing to be in. So since there's so much hoopla over Boeing right now, and the big gap down with them having to ground so many planes around the world and stuff like that. It's causing them problems. And when I was digging into the stories about what happened, their big competitor is Airbus, which is overseas, and so Airbus has the kind of like the equivalent, competitor type thing to Boeing, and Airbus totally remade their planes and made them lighter and more fuel efficient that way. And Boeing decided to go a different route because it would cost more to totally redesign a plane than it would to just change a few facets about it and take out some former engines and put in some newer, more fuel efficient engines. And then those engines had to be placed at a different point within the plane, which changes how pilots are used to operating them, because they feel they want to, I can't remember if it was nose down or nose up, I think nose down, unusually. And then to compensate for that, they had these computers that could kick in and supposedly help correct that problem. And so there's evidently a problem with the software, and who knows, might even be far bigger than that. And then Boeing blames the government and says, well, yeah, but if the government shutdown delayed our software upgrade by 5 weeks. Okay, well, the previous crash they had before that was 5 months ago. So what was their story then? So they're trying to get off the hook and divert. And again, if any of you work for Boeing, don't take this as a personal thing, because this was a top executive decision. So it has nothing to do with your job if you work at Boeing. And Boeing overall is a good company, but it's gotten way ahead of itself. When it starts to not hit on all cylinders, it crashes hard within a short period of time. Since everybody and their mama is hitting the sell button and nobody is hardly hitting the buy button, then when you want to sell, there's a lack of liquidity on the buy side, because when you sell, it's got to be to a buyer. There's a lack of buyers, and that's what causes these gap downs and these huge down moves, to where it can move down 16% in just 2 or 3 trading sessions, and the worst is ultimately not over. Now, it could have some recovery. Again, it can have some bounce or recoil or snapback or whatever before heading lower, but that next leg, whenever it does come, will be brutal. And here's what I'm not saying. I'm not saying this has to be the first leg of it, but we're seeing the volatility where things aren't hitting right. So I mean, it could do this and then this. I mean, that's drawn down a bit too far, but where this is probably more likely, something like that. This could happen too, and either one would still be there would still be the enormous risk, the enormous downside volatility, etc. So it's just something that you really don't want to get involved with, in my opinion. And I know, most of the media outlets out there, most of the people who get into stock stuff are, attracted to momentum stocks like the moth to the flame, and it usually eats them up and spits them out, and they get so drawn in because they are making money during this phase, and that's undeniable. The problem is they never know when to exit, and they never know when to get out, and their greed is so taken hold of them that they feel, well, if I get out now, it's going to go from 450 to 550, 550 to 650, etc., and I'll have missed out on so much upside. So what happens is they ride it through and past the top and onto the downside, and the downside is even more so like the roller coaster. How this roller coaster, you go tick 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 tick, and then you get to the top and it goes swoosh, and that's the way the downside feels like relative to the upside. And the more parabolic move to the upside, typically the more parabolic move to the downside, because it was such an emotion-based, euphoric move to the upside, and people didn't know why the heck they were buying it, except for it was going up and going to the moon. And they're filled with such quick self-doubt when it turns and it bites them in the butt and they're down on it, and they make emotional move to sell. And collectively, people doing that in mass sends it much lower. And parabolic moves have far more participants sucked into it right up here at the top. So picture this: as this parabolic move goes up, more and more and more people getting into the trade. And so by the time it gets slammed, you have your maximum amount of people that could ever be affected sucked into that trade. So that's why it affects so many people, and that's why one of the reasons why the downside lasts so long, because it takes a while for all these people to get to be able to pile out of it. And you know, the people piling in when the angle's like this and the people piling in when the angle's like this is two totally different things. This is getting so much more news press than this is getting so much more emotion and excitement and greed worked into it than even, you know, this type of angle. And so there's all kinds of dynamics as to why that is the case. But really, you know, you can always just look on a weekly 10-year chart and see where the price is and see where it is relative to the 200 week moving average, and see how that corresponds to what it's done in the past. And you can easily spot bubbles, and you never have to be a part of one. Also, there's other dynamics going on here where the RSI is losing steam, the selling volume is just you know, crazy, and the MACD is losing steam and all that. So that's why I think this scenario here is more likely than this other one. But either could happen. So if you don't know how to set up your charts the way that I've got them set up, you can go to the Ask Sean section on SeanHyman.com. Scroll down to where you see this big laptop, how to set up your charts. Click on that, and it literally takes you to a video. Click on that play button there, and I will show you how to set up those charts. Those are free charts. They don't cost you. You don't have to subscribe to anything monthly. And there's some of the better charts that I believe that are out there. And again, I don't get any kickback, or, you know, there's no ties to me and the company that runs stock charts. So it's just what I've used for years, and I love them. I've used a lot of others, and there's one other charting package that I use that's free, TradingView.com, for one particular volatility indicator, and it's really mainly because Stock Charts doesn't have it, or doesn't have it for free. So if I can get it for free and have it in real time, why not? So anyway, enough about that. But I hope you've learned a lot of lessons just within me using this example, even though it doesn't involve one of our stocks. So so the S&P still is lofty. It itself has been far away from its 200-week moving average, and it unraveled quite quickly. And many people didn't realize those risks. And again, just because it is, you know, it was far from it here too, and it doesn't mean that it has to have that unravel on that particular pullback. You know, it pulled back and then it rallied to one more high, but then it got slammed. But either way, you know, the risk was high here, and it went far lower here than what it was here, and you didn't have to ride through any of that, you know, downturn. Just being you know, conscious of, you know, are you buying in when the price is elevated far away from the 200-week moving average? So that's something you can keep in mind when you're doing buy-ins in your 401ks and IRAs and stuff like that as well. Which you know, this is likely to happen somewhere. The market is still, I believe, likely to correct somewhere between the 19 to 1400 area at a minimum, and it could go further, because the market has to condense those PE ratios and that are in the stratosphere right now. And I believe we're you know, in that toppy phase. You've got the RSI that is steadily putting in lower highs, showing loss of momentum. You got the MACD doing the same thing. You got the selling volume picking up. When the selling volume is picking up near the end of wave 5, that's institutions doing that, you know, more than anybody. And because you can't hardly pay retail investors to get out of their positions near the end of wave 5, because they believe that this thing's just going to go on forever, you know, at that point. So they feel like they're missing opportunity. They don't even see or believe this could even hardly be in the cards. So so the S&P 500 is you know, definitely overbought in the near term, on the long term. On the daily chart, you know, there's basically a resistance zone that's, you know, right in here around the 2800, 2815 or so area. And again, that is a zone, that is an area. For instance, you'll see that the price peaked just above 28.15, which was the high here, to go to 28.21, just enough to turn around and head back into the range. So a lot of times institutions know that, and they'll try to play short-term tricks with you, and throw in a bunch of buy orders, because why? They know a ton of people have pockets of sell orders up here, stop orders up here, that they can trigger and cause losses or somebody to get out prematurely, and then they can bring it back into the range. So in near-term intraday trading, there's a lot of tricks and weird stuff that goes on. Again, with what we do at Logical Investor, it doesn't matter what intraday traders do. It has no bearing on on how things unfold with us. But notice, even on the daily, you're getting slumping RSI. Really, this is just kind of flat here. I mean, yeah, you could say it's down a little, for sure. And this could turn up, this could open up and turn down. It could do either one, but you get more of your reading right here on what's happening there. So I'm looking for this to ultimately head lower. Now, is there a possibility that we could go back and retest the old highs or something before that happens? Absolutely, we could. This does not have to hold; it's just likely to hold because it was kind of a resistance zone even over here, broke out of it, but it was really resistance here, 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 and here, and so here we are at it again. Now, it may hold or it may break above it a little bit, and keep in mind, it can even break above it just a little bit and do a false break and head lower. So any kind of combination like that can happen. But ultimately, I'm looking for this to head lower. So in light of that, it's likely good to be holding a lot of cash in your 401ks, IRAs, stuff like that still until this this big move unfolds to where we get back down into the much lower levels on the S&P 500. The PE ratios are compressed, and there's true values to be had. And by the way, at those times, the news will be tremendously negative, and fear will be so thick you could cut it with a knife. And that's not the case that we're in right now. So there's no need to be, in my opinion, be allocating fresh cash to new positions when this is the case. All right, so I'm going to start going through our positions a little bit more quickly because I spent quite a bit of time on Boeing and the overall market. So let me get this typed in right. So GLD is still trending higher highs and higher lows. Somebody said the other day, I'm surprised, gold was down with the market being up, or maybe it was vice versa. I can't remember. But anyway, the intraday correlations are not there. I mean, gold can do anything near term within a day or two or a week or two or whatever, and so can the markets. The correlations between gold and the market and gold and the dollar, happen. Those inverse correlations happen over time, meaning over months and years. The correlation is extremely strong. But and the reason is because near term people sell any asset for any reason. They don't have to say, well, how's this correlating to the S&P or anything like that. They can just, for instance, I could be a seller of gold here if I were a trader, and I'm an investor, but if that's just purely a trader, but simply because this ran up, and I bought it down here, and it came up here, and I could be selling it off, and so and yet I could still even be selling it off as a trader and still be bullish on it later, and trying to play around and catch it back lower and so forth like that. We don't do that in the Logical Investor, because what you'll find is, one, you're going to increase your commission costs by going in and out, in and out, in and out, and you're going to take your taxable gains for sure, guaranteed short term rather than long term. Although we don't make any decisions on when to take profits or anything off of taxes, but I'm just saying that happens to be the case in the in and out versus holding on. And inevitably, when you in and out enough, you will miss a move and it will take off and leave you at some point, and you're not on the train, but the train left the station. So by us investing in it, we're always on the train when the train leaves. until it's truly time to exit. So GLD, had gotten far away from its 200-day moving average and even a bit away from its 50-day, and it had come up here into the top band. So really nothing strange for that to pull back closer to that. So anytime I've taught you this through the years, anytime you see the price get far away from the 200-day moving average or the 200-week moving average, just know it is not uncommon for that to have quite a pullback. Doesn't mean it has to happen. It means it's likely to happen. So we're experiencing that, but yet we've got overall higher highs and higher lows. Now in the interim, like I say, hey, this could take back off, or it could come back closer to this 200-day moving average and then take back off. Whatever, any of that's possible. So just know it's normal market mechanics. Even if it did something, and I don't expect this one, but even if it was quite a bit deeper and heading higher, that could happen too. Again, I don't expect it, but just know anything like that is normal market mechanics. So in other words, that means that's typical fashion, typical ways in which the market tends to move. So that would be nothing shocking there. Then we've got CHL. CHL is close to a sell point. As a matter of fact, if you personally are up, 18, 20%, something like that, you can go ahead and sell and lock in a guaranteed gain. And the rest of us will wait for the official sell signal. Now, the logic may be, well, if you're so confident that there's going to be a sell point at 55 or 56, then why would I sell now? Here's the reason. Because let's say you are up 18 or 20%, and let's say it doesn't go up that extra buck or two first, and let's say for some reason it gets slammed, in the near term, because that could happen. I mean, the price is far away from the 200-day moving average, and then it goes sideways for a bit, and then it eventually starts heading back higher. Well, this next turnaround, I mean, that could add a lot more months to you, to your investment, whereas you could shorten that time horizon here. Again, if you are up that much. If you're not, if you're up 8, 10, 12% or whatever, you should just hang on and wait. Whether the stock goes to 55 or 56 and we can get out near term, or whether it takes that dip in that process, which I don't even have enough room here to draw how long that process could be. That could be a short dip, it could be a shallow dip, it could be V-shaped, it could be U-shaped. There's all kinds of things that determine the time horizon that we don't know into the future. That could elongate that investment months or another year or so. We don't know. So that's why when you are in a time where you have unusual gains, I would say lock those in, even if you lock it in and then in the near term the price goes a buck or two higher or whatever. Because here's novice thinking. If they lock price in and it goes a buck or two higher, they go, oh darn, I should have waited. Here's the problem. You don't know the future, you know what you have today. And if this would have happened, you would have said just the exact opposite thing. Oh gosh, I'm glad I sold when I did. So you never know near term what tomorrow holds, but you know what gains that you have in your hand today that you can capture. And so that's something that the pro considers is, I know the guaranteed outsized gain relative to the market that I have today, and that I've gained an unusual percentage amount in a short, relatively short period of time, for investments. And so it's prudent to take those unusual size gains. And again, if you're up 5, 10, 12% or whatever, you can hold on to it and ride through whatever dips they are until we get to that $55, $56 level, and that's probably where we will sell. And where does that come from? Remember, long-term charts matter the most. And where is resistance? There was 55.87 here, 56.89 here. So these were a couple of big sticking points. Yes, you had one brief period that went up to 64, but you had a lot more time spent in the mid 50-ish area. So that's like the next resistance area. So 55 to 56-ish area would be where we would be looking to take profits. Again, another thing to note is that the price is far away. It's not far away from the 200-week moving average, but it's far away from the 50-week moving average, which the 50-week normally stays closer to the price even than the 200-week does. And so, but you are dealing with, an emerging market stock too, and those don't tend to trade as often like this as they trade with these, steep angles. And so, being that that's the case, you don't know exactly where that ends. So, I mean, they can pull far away from the 50 weeks, but just know when they do that, there is coming a time where that is likely going to correct itself. The question is whether it pops higher first before correcting itself, or if it corrects itself first and then later on pops higher. So, so again, those are all the factors that roll around in my head when I say, hey, if you're up X amount, you can take profits on it, but if you're not, you can hold on. So FXB is the next one. Again, people have asked me, hey, are you, worried about Brexit and all this kind of stuff, and no votes and whether there's early leave or something gets extended or what, all this kind of stuff. No, I'm not. And why is that? One, because it's still one of the most solid currencies of the world. It obviously has extreme negative pessimism, as we can see from the volume on the long-term charts towards the end of wave C and towards the end of wave 2. So why would I be scared or bearish? And the pros, who already know what could be, basically pretty much the worst case scenario for Brexit, have already factored that in when they pummeled it down here to the 117s. So, and pretty much everybody and their mama that was going to get out, did it towards the end of wave C or the end of wave 2. Well, the people that sold out towards the end of wave C in the 117s, 118s, 120s, they're already kicking themselves because this has already been as high as 139 since then. And the rest of the crowd sold out here around 121 to 122 or whatever, and it's already back to 128 and likely getting ready to to head higher again itself. But it could have any kind of volatility, near-term volatility to the downside or the upside. But ultimately, if this is wave 1, this is wave 2, then we ultimately have a pretty good size move coming that, since former support was 140s, former support becomes future resistance. And so, 140, 145 would not be uncommon. And again, it could go much higher than that, but something like that would be very realistic. So, yeah, I'm not worried at all about. And if I were a news trader, I would be nuts right now, because that's why news trading is so fickle. You wake up one day and turn on the TV and you're looking at CNBC or Fox Business or whatever. Oh, things look improved and it looks like this is going to happen, that is going to happen, and the pound goes up. And then you wake up the next day and it's like the whole world changed. And you click and, oh, this happened and that happened, and this group's not going to accept this, and blah, blah, blah. And there's all this infighting and bickering, and and all of a sudden the pound's going down that day. So that's why we don't play the near-term intraday trading game. That's like the toughest game in town. It's one that you're not likely to win. Anybody can win as an investor, knowing fundamentals, knowing sentiment, knowing Elliott waves, knowing just how markets work. And that does take time, but time is all we got, right? I mean, I'm 49. I could have lived 100 plus, whatever. I mean, all I've got is time. If I for some reason I didn't, and again, I believe for long life, because you can go to BibleGateway.com or others, and you just put in long life or length of days or something like that. The Bible promises you long life, so you can believe for it. But but let's say I didn't, and something happened, and I died at 70 or whatever. Well, then, my assets can go to, my kids, which have time. So, there's always time for me or the next generation or whatever. So time's all we got. So don't worry about and being so antsy about, oh, something's got to happen in a short, period of time. That's really just practicing in patience. If there's one sign of maturity, it is how patient you are. And if there's one sign of immaturity, it's how impatient you are, no matter your age. So if you're easily set off, and you're 50 or 75, that's an immaturity, and it's a character flaw, and it's an immature area of your life that you need to address. Um, and again, getting in the Word of God, prayer, church, getting around godly people, listening to praise and worship music, putting good stuff in your head, that all is going to help you tackle that stuff and strengthen your spirit to where you reign over and rule over your spirit well. Bible talks about how a man that can't rule his own spirit is worse than a city with broken down walls. And so, that's probably a word for somebody right now that, what you're going through. Maybe there's an anger issue, maybe there's something with a spouse or what have you, or maybe with your kids or whatever, that if you don't correct it, it's not going to end well for you. And the Bible warns against that. And so if you don't correct it, it could cost you your kids, it could cost you your spouse, what have you. So, and that's if you're male or female, doesn't matter. So I believe that's a word for somebody, just prophetically for somebody. I believe it's a timely word for God. I believe it was the Spirit of God speaking that. So anyway, and by the way, if you want to chime in and say, hey, that was for me, you're more than welcome to, whether in a direct message or publicly on the site, because either way, there's no shame in saying, hey, that was me and I need to correct something. It's very honorable to do that. So FXB, again, very bullish on it. Believe that it's going to do very well over time, no matter what happens near term. I believe the worst has been baked into the cake. Remember when I told you that people overshoot an investment to the upside? They also overshoot it through fear to the downside. How do you know fear exists? See these huge, big selling spikes? That's not because they were thinking the world was all peachy concerning this asset. That's because they thought, oh my gosh, we have got to get the heck out of here because this is cratering. So very irrational thoughts, very emotion-driven thoughts. They're gripped by fear, which they should not be anyway. The Bible says God has not given us a spirit of fear, but a spirit of power, love, and a sound mind. And one verse says self-discipline. So, but again, and as we learn that, we can learn to be more even keel and less emotionally driven just by following biblical principle. So learning the Bible can teach you a whole lot about even how to manage your emotions as it concerns your investments. It's very practical. It's not just a book of ancient stories. There's a lot of practical wisdom that'll be true 2,000 years from now if the world still exists. EWW, it came down, had a V-shaped bottom, bumped its head against its 200-day moving average. And this one I'm very bullish on. Again, we're seeing some signs that there's a slight tilt there, but it's really bigger on the MACD is where you see it the most. So, this is firming up. The selling volume, which the spike here is starting to get lower. So I believe we're gearing up for our run to hold above the 200-day moving average. Question is, do we have more pullback before that happens, or have we already had all that pullback and that happens, from there? And we don't know that for sure, but what we do know is that the PE is cheap. There is a lot of institutional money that's moving towards emerging markets of all kinds, and so that's helping firm things up. And you can even see here as the masses sold off, see this big buying spike here. That's institutions that will run in and jump in and buy something when it's fallen like that. The retail investor has no guts to do that because, again, they don't know the soundness of fundamentals and cheap PEs. They just know, oh my gosh, something's falling on the chart and it's probably going to get a whole lot worse. That's all they know. And even if it did, professionals, use averaging down techniques to get lower and lower break-even prices to where they use volatility and downtrends to their advantage, not to their disadvantage. So the novice investor and novice trader thinks downtrends are to my disadvantage, and the investor knows that downtrends and volatility, especially downside volatility, are to the investor's advantage, not disadvantage, because as they structure and plan for it and have cash to take advantage of it. It's what Warren Buffett does all day long, and it's helped me to pick that up and learn from him in that area. So EWW, very bullish on. I believe it's going to do very well over time. And then GDX is next. Of course, as gold has been having higher highs and higher lows, GDX has been having higher highs and higher lows. And both gold and GDX have been on a run for a bit here. So I mean, if it did something like that would not be unheard of, or we may, have already experienced all the pullback it's going to do, and you just have shallower pullbacks and so forth. Either way, it doesn't matter because these companies are cheap. They're going to expand those PEs. They're the few pockets of value. Money's going to run from overvalued to value plays. We're seeing, the MACD continue to firm up. We saw the peak of maximum pessimism here and right here, and then it started, falling off quite severely. We've been seeing the RSI pick up steam. So again, lots of technical signs there that there is a shift that has happened. And anyway, I believe that's I'm just very bullish about that ETF. So LPL is next. This one has been relentlessly putting in higher highs and higher lows, and now it's climbed above the 50 and 200-day moving average, and now there's a golden cross, and so there's all kinds of good technical signs here that are bullish and showing that there's accumulation going on in the stock. There's been a downtrend broken as well. RSI has been heading higher overall. MACD's been heading higher for quite some time. Selling volume peaked right here and has been heading lower over time. So there's all kinds of positives there. But it doesn't mean that this can't. I mean, this could trade sideways for a while longer and then take off. It could pull back closer to the 200-day moving average in the lower Bollinger Band and then take off. I mean, any of that can happen in the near term, but I'm expecting this turnaround to continue. And again, could you get sometimes you can get some fairly stiff corrections back before heading higher. Could that happen? Absolutely. So this does not mean this is a downtrend just because this particular line here gets broken. If this pulls back and has higher lows or even equivalent lows to here, then there's chances that it's still an uptrend. And particularly with all these technical improvements, golden cross and all that, I believe that we are off to the races there. So I believe that's going to continue to improve overall, and is a pocket of value that will prosper over time. So BBBY is one that ran up very quickly, shot from 10 to almost 17. Matter of fact, it may have even touched 17 right there. That's a lot very fast. That's not normal market mechanics when you have a move that is angled like that. So it's normal to see some correction of that, and that's what we're seeing now. Question is, how deep does it go before it goes to its next push higher? We do have a very strongly upward moving 50-day moving average. So we could see that do this. We could see it be something mild pullback and head like that. That's the more likely scenarios. But is there a scenario where it could come back and come closer to its old lows before heading higher? Sure, any of that stuff could happen. I'm not stopping it here. I'm just drawing the lines upward to show the direction. I believe this should have no problem hitting the 2021 area probably in the coming months ahead. And again, ultimately long term it could do much more than that. But since this got slammed here and you were able to get averaging downs, in that just by the time it gets back to that original entry point area, you're already in a market beating return, even if it never uptrended again, which it will, but even if it, or I believe that it will, but because nobody for sure knows the future per se, but when you're dealing with solid companies, low PEs, negative sentiment, as a basket, as a group, those stocks should do well. Now, any one particular company, something can happen, something surprise you on or whatever, but in general, you stick with that same thought process through whatever winners and losers you have, because overall you have winners because of it. It's a long-term edge that it gives you. So CAJ, lots of technical observations here that stand out. One, this is getting stronger here as we see it overcome this line here. The 50-day is now curling and heading higher. The point of maximum pessimism was undoubtedly right here, and that has really dropped off big time, which is bullish. Your MACD has been heading higher. RSI has been heading higher. So there's firming up of momentum there, which is really good. Pretty much everybody who was going to dump it and sell and what have you likely already did it right in this area or shortly thereafter. And so they dumped it in the 27s, 28s, and they think that they did the right thing because it drops another buck or two, but then it's already been as high as 29s, and when they see this happen, they're going to be kicking themselves in the butt. And again, you can always get some pullback before that heads higher, but you can almost always count on the masses to sell at the worst time possible. So, and had they known fundamentals, they wouldn't be sellers. And had they known sentiment and contrarian thinking and Elliott waves and other things like that, they wouldn't be selling. But what are most investors? Most investors are emotional investors. What are we? Well, at least I'm training you to be logical investors, and some of you are emotional investors at times, but I'm training you to be logical investors, and some of you are getting there, and some of you still got a little bit to go, and that's okay. It's what you're here for, right? Even once you got it, it's good to still be hearing, a voice like mine, just to keep you mindful of it, to where you never, veer away from it. So here's just some observations for IBM. IBM got slammed. Point of maximum pessimism both here and right in here, but here's the biggest one because you had a couple of massive spikes here, and then the selling volume drops off big time. Big buy spike came in after that, which that's definitely institutions. This is definitely a lot of moms and pops selling near bottoms, and also some institutions that lose their head as well. But that selling volume has dropped off big time. RSI and MACD firming up, and you've got a golden cross that's pretty much about in the works, and it's recovered big time. So here you have everybody and their mama selling out at 111, 112, 113. Don't you know they're kicking themselves when it goes to 140? So again, you can count on people to do the emotional thing, which tends to be the wrong thing more times than not. It's an immaturity. When you are fear-led or greed-led, it's an immaturity in your character, and it's something that you've got to rein in. Again, it's another thing that the Bible helps us with. This may have some sort of pullback. Could be shallow or a little more deep or whatever. Nobody knows for sure. Or we could be at it now, and it's had all the pullback that it needs. But I'm looking for this to head higher, no matter what kind of pullback it does, shallow, deeper, or even if it's done for. And then as this pushes higher, the good thing about this is it got slammed enough to where you've been able to get your averaging downs in. So we got in at in the 146s. So 146s, and it's been as low as 104s. So you've had more than opportunity to get averaging downs in, to where as it's come back around, if you've done it right, you should already be profitable on it. And then just a little bit more bump up, and even by the time you're back to the original entry point, you're already so profitable because of your other buy point or two that was bought so much lower that has averaged your gain so well. So it's one of the big reasons why I love averaging down, because if you're starting, you're buying at a value, and it gets to be much more of a value than you're buying at even lower PEs and higher dividend yields. And if IBM just went semi sideways, all over here, crashes down here, and then comes back and just hung out again and again, didn't even go into higher highs, new 52-week highs or anything like that, you could still make a market beating return even without it ever trending higher again on the daily chart, much less the long-term chart. So I love that aspect about averaging down. And then, so, obviously very bullish there. KHC, this is one, when a stock gets slammed like this and gets so much press in the near term, you have massive selling spike, and then that selling spike dies off big time. And it doesn't necessarily mean we're at the bottom here. We may be at the bottom here where this area, in the 31s, 32s holds, or we could have one last leg down a bit before we see that recovery. Either one of those could happen, and it does not have to climb this steep. I'm just, I'm running out of chart, so I had to show the direction. That could happen over, weeks or months, or that could happen over the next, 2-3 years, the time that it would take for that to happen. But what I do like about it is that, about a third of Kraft Heinz float was traded right here in this one day. Of 125 million or so shares traded, and then still a ton traded even the next day or two after. So that has wrung out a ton of the sellers, which is good. So it's going to make it a little easier for the buyers to come back in. But when something does get hit so hard in such a short amount of time, it does make a lot of investors a little bit squeamish to step up and buy quicker. So that's why it could drop to even a bit more of a value before it heads higher, or we might be at it now and we may just, we could head higher from here. So what I like about it is that we've been able to average down from the 55s to the 31s. And so, again, it doesn't even have to even get back to our original entry point for you to make money. It can be hanging out here around the 200-day moving average, and you make money on it. So structuring buys like that is an amazing thing. And again, this could very well and probably will someday go back up into higher highs and whatever. But for our purposes, it doesn't even have to, and we make money. And so I just love that. So ticker symbol E, they had an oil discovery and a gas discovery, which is good. And then OPEC is staying tighter on oil production. A lot of the shale drillers have tightened production, which all that helps oil's price to go higher. As oil goes higher, that's better for oil companies. And so ENI, which is ticker symbol E, has done well lately. I mean, it's come from 29s to 35s, but it has been overbought for a while overall. So it would not be shocking if this corrects some of that before heading higher. So just know that. The people who bought at 29, 30, 31, if they're traders, and all of a sudden it's at 35, they're apt to take some profits. And when they take some profits, that brings this back down some. Question is how much? Is it just a little bit, or and then goes? It doesn't even have to go. It can even go sideways and then go. Those aren't as common, but that can happen. So anything like that's possible. Even something that's a bit deeper can happen. But ultimately, this stock is going to go higher because it was bought when fear was great and when hardly nobody was wanting to get oil stocks because the oil got slammed. Also, you had your point of maximum pessimism back here, and it has fallen off big time. You've got your MACD is heading higher. Your RSI has been heading higher. So there's a lot of firming up here. But this V bottom probably we'll have some sort of pullback to form some kind of higher low relative to this before heading much higher. So just expect that. Again, when something's at the top of a band and it's at the Bollinger Band and it's hitting its 200-day moving average for the first time in a while, it typically doesn't overcome it the first time out. And when I say that, I mean it could pop above it a little bit and then come back. Anything like that's possible. I mean, sustaining itself above it is rare, and so set your expectations properly, like that. Even though it's been cool that this is zipped up and we're temporarily up on it, just know there could be a pullback that takes us not being up on it in the near term, but comes out of that and goes to an even higher high, because again, cheap fundamentals eventually become much more expensive fundamentals, and that's going to come as the price rises. So this is going to rise, and as it does, we will do quite well. The question is, will it be quicker or longer? Only the market knows. We don't know the pace or the exact time horizon that happens, because that's dictated by the market. We just know the only thing we can control is our entries, right? So we start our entries only when it's prudent to do so, when the asset is solid and low PEs, and then we can have averaging downs. I'm just drawing lines on charts to where when there's prices move down and head back up, that we can make money even just near original entry points or whatever. So again, I'm not saying those are the average down points at all. I'm just giving you visuals. So we control the entry points. The market controls how soon we get to exit. That's my whole point in that visual exercise. Sometimes that may come in months, and those will be rare. Most turnarounds and heading higher tend to take a year or two at least, and sometimes longer. And that's why, again, I say we have a time horizon that's generally 2 to 4 years of length. And some stock investments will be a little bit less than that, and occasionally some will be a little bit longer than that. And then if they are, okay, you just be patient and rake in your dividends while you wait. And I mean, if you just had it sitting in a savings account, you'd earn jack squat anyway. So whether it's a stock you're in that earns 0.5% or 1% or 3 or 5%, you're still probably earning more while you're waiting than if the money just been sitting in a savings account. Again, you want money in a savings account and a lot of liquidity there, because if you don't have money in a savings account and all your money's in investments, then what you've got to do is you've got to liquidate an investment at the most inopportune time to take care of a liquidity crunch, because 4 tires on your car went bald or your water heater went out or whatever it is. So, and again, I teach on that in my book called The 6 Keys to Financial Success. So you can Google that, you can put that in Amazon, whatever, if that's something that interests you as well. But I'll also teach you a lot about what the Bible has to say about money. So anyway, that is it. Pray it's been a blessing to you. Thank you so much for watching, and God bless. Bye-bye.